Today, Goldman Sachs not only reaffirmed, here's the big stuff, not only reaffirmed their 3,300 target, revised, I should say, their 3,300 target, they also upped their aggressive case from 3,500 to 4,500. They now anticipate even stronger Chinese demand than previously modeled. Note, they were very conservative post-election, and that arrow just keeps creeping higher. If the largest official buyer, China, we're targeting an allocation of 20% and maintain an average pace of around 40 tons per month in line with recent patterns. We estimate it would take approximately 3 years to reach a 20% gold share. China is going to be in the market for 3 years unless they decide to buy it tomorrow, and then we get 4,500 an ounce.
Goldman noted that official sector gold demand could average 70 tons per month in 2025, up from a previous estimate of 50 tons. The bank emphasized that since the U.S. froze Russia's reserves in 2022, central bank gold purchases have nearly quintupled. China is likely to continue its aggressive gold buying over the next 3 years. Legendary commodities trader Vince Lanci underscores Bank of America's and Goldman Sachs' new gold price target, driven by a projected rise in investment demand. In addition to raising their primary price target, Vince also talked about how gold could exceed $4,500 per ounce in the next 12 months. Despite gold prices surging 15% in 2025 to reach record highs, Wall Street is again raising its gold price targets amid growing uncertainty fueled by U.S. tariff policies and geopolitical tensions. According to Vince, China's gold demand remains strong, with potential purchases continuing for at least 3 years if its central bank aims for a 20% gold allocation. China's gold reserves rose to 73.61 million fine troy ounces at the end of February from 73.45 million at the end of January, as the central bank kept buying the precious metal for a fourth straight month. From a technical perspective, Vince mentions that institutional insurance firms are increasing their gold allocations, reinforcing Bank of America's projection that a 1% rise in holdings would significantly boost demand. He notes that Western investors are returning to gold, with ETF inflows rising and central bank purchases providing consistent support. North American investors have led the charge, accounting for nearly $12 billion of the total inflows, while European and Asian investors contributed $5 billion and $2 billion respectively. This regional distribution highlights the global nature of the current gold rally, with Western investors particularly keen to increase their exposure. While reflecting on the market, Vince notes that U.S. policy uncertainty, inflation fears, and excessive debt drive investors away from tech stocks and U.S. treasuries. With both Eastern and Western demand surging, he suggests that gold's bullish momentum only strengthens. Investors abroad sold longer-term treasuries for 3 consecutive months, a sign of central bankers reducing their reliance on the U.S. as a financial buffer. Now we present the clips of Vince Lanci's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
In a report put out yesterday, Bank of America says gold at 3,500 an ounce. We believe gold could rally to 3,500 an ounce if investment demand increases by 10%. So we make this our new price forecast. The report then proceeds to go into why that will happen without being obnoxious about it. Goldman Sachs today says we raise our end of 2025 forecast to 3,300 a troy ounce versus 3,100. And our forecast ranges 3,250 to 3,520. That's their low to high normal baseline. In extreme, this is the new part, in extreme tail scenarios, gold could plausibly trade above 4,200 an ounce by end of 2025 and exceed 4,500 an ounce within the next 12 months. So 4,500 an ounce by Q1 of 2026. On your screen, you see on the left-hand side, that's Bank of America's forecast, simplified. And on the right-hand side, that's becoming a very popular graphic in our community. That's the Goldman Sachs forecast. Let's go back to what Goldman said. When they first revealed their new valuation methodology about 4 months ago, it faced pushback. Some banks resisted, citing Fed rate hikes and a strong dollar as headwinds that would eventually cap gold's rise and probably cause its demise, at least short term. But even those banks began to adjust, especially after seeing continued and surprising central bank buying post-U.S. elections. The scale of those purchases is forcing a reevaluation. Today, Goldman Sachs not only reaffirmed, here's the big stuff, not only reaffirmed their 3,300 target, revised, I should say, their 3,300 target, they also upped their aggressive case from 3,500 to 4,500. That new projection is based on three factors, okay? First, China. They now anticipate even stronger Chinese demand than previously modeled. Note, they were very conservative post-election, and that arrow just keeps creeping higher. Quote, if the largest official buyer, China, were targeting an allocation of 20% and maintained an average pace of around 40 tons per month in line with recent patterns, we estimate it would take approximately 3 years to reach a 20% gold share. China is going to be in the market for 3 years, unless they decide to buy it tomorrow, and then we get 4,500 an ounce. Insurance companies, echoing what Bank of America said, they also now publicly acknowledge that insurance company gold buying angle, as Bank of America already has, discussing using their math, saying a 1% increase in gold holdings, which is what these insurance companies are going to do, adds a percentage to the gold demand. They actually break it down where the demand is and how it adds to price. The third one is Western buying, which every bank has discussed, but I think Goldman has been really on top of, perhaps with Citibank as well. We don't see as much of their insights. We wish we did. Quote, over the span of 6 weeks, and here's the key, speculative length declined by 150 tons, yet prices remained supported by structural demand, including a notable pickup in gold ETF inflows, around 80 tons. What we estimated to be ongoing central bank buying amid rising U.S. policy uncertainty. Now, we will get into why and what and the details of this another time, but it really comes down to this. The West, at the institutional level, is buying and trading gold. They're buying the dip, they're buying the rally, they're selling the next higher rally. ETF flows are becoming more consistent from Western investors, and Americans are looking at dollar correlations again. When the dollar gets weaker, they buy 5 contracts. When the dollar gets stronger, they sell 3 contracts. So the correlation is back at a higher level, but it's really working as a net upside kicker for the market. And that's because you can thank the previous administration, and you can thank COVID, and you can thank anyone else you want in a partisan political fashion. But that's because the nation has been reacclimated to the fear of inflation, has been reacclimated or acclimated to the fact that we could theoretically default on our debt. We have too much debt. The nation has also been shocked very recently into looking at their Mag 7 stocks, their AI stocks, as being overvalued. And there's a demand for alternatives that are not U.S. Treasuries, not just overseas, but domestically. Okay, I don't care how high the rates are in the U.S. 4% is not enough. A portion of my money is going to go into gold. A portion of my money is going to go out.
Analysts like Vince Lanci mention that Bank of America identifies 2 key drivers of gold demand, namely central bank diversification and the entry of Chinese insurance firms into the market. With China's new pilot program, insurers are expected to accelerate gold purchases. These firms alone could remove 300 tons of gold, 6.5% of annual global production, potentially driving prices higher. China has initiated a pilot program allowing major insurance companies to purchase gold for their balance sheets and client investment products. GoldFix believes China's domestic insurers have earmarked $25 billion to be invested in gold per the mandate's rules of the pilot program. Putting concrete numbers behind this, Bank of America believes 300 tons of gold purchases, or 6.5% of the annual physical market, would be removed. If BOA is correct, this new demand correlates with the dislocation of approximately $500 in price. Despite these bullish fundamentals, Bank of America appears conservative in its price forecasts, possibly due to strategic caution. Let's get back to the interview.
Bank of America's view is, well, they revised their target, and it builds on a theme they introduced last month. Their key idea is, if Chinese insurance companies are permitted to purchase gold for both their balance sheets and client-facing products, how much could they realistically buy, and what impact would that have on price? That's one of the focuses of their main report. Another key area, arguably more innovative, at least so far, is Bank of America's further quantification of potential central bank purchases in the current geopolitical environment. Presently, central banks hold approximately 10% of their reserves in gold. Bank of America presents a case that this share could climb towards and reach 30%. Bank of America says this and justifies this projection and explain its relevance. They openly discuss the risks involved. We agree this is where things are headed, relying on efficient frontier type analysis. The sweet spot for central bank unhedged ownership is around 25 to 30% by our calculations. Essentially, a little bit off script here for a second. The conversation for the past 2 years has been de-dollarization. The conversation at the banks for the past year, 6 months, has been de-dollarization. Nobody is questioning that anymore. Now what they're saying is, how de-dollarized will central banks get? And the answer is, if they want to achieve efficient frontier portfolio balance going forward, that number, Bank of America says, is about 30%. We agree. It will probably be more than that if they start utilizing hedging. But let's stick with 25 to 30% for now. It's worth noting that the Chinese insurance company gold purchases are economically separate from central bank buying. Here are the nuts and bolts of that portion of it. China has initiated a pilot program allowing major insurance companies to purchase gold, both for their own balance sheets and for client investment products. We alluded to that earlier. Goldfix believes domestic insurers have earmarked about $25 billion to be invested into gold per the mandate rules of the pilot program. We also believe they will put that in there faster rather than slower. Why? Because China's interest rates are so low that the demand for higher yielding yet safe products mandates from the client base, we want something that also doesn't have a high interest rate, right? But gives us safety. So the concept of opportunity cost factors in very big in China now. Putting concrete numbers behind this, Bank of America believes 300 tons of gold purchases, or 6.5% of the annual physical market's production, would be taken off market. Now, we have a rule that we learned from Victor Niederhofer years ago. We had dinner with the guy. He said a 5% decrease in supply equals a 20% increase in price as a rule of thumb. And we got into all the reasons for it. So 6.5% off of physical supply, let's call it 5%, if the insurance companies were to make good on their purchases, which we believe they will. 1% is what they're permitted, and 1% is what they're probably going to do. It will take 5 to 6.5% off the market. That would add about 20% to price. That's $600. We still think Bank of America is holding back on their price target. Perhaps because they want to be careful, perhaps because there are other bullion banks with exposure. We'll never know, but that's the point.
In a world that is spun in ever faster geopolitical tension, gold maintains its position as the safest asset for investors seeking stability. With central banks accelerating their gold purchases, could we see gold surpass even the most aggressive price targets sooner than expected? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.